This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On today's show, in addition to more news about the Fed and their intentions for interest rates, we start to digest companies' fourth quarter earnings results and their guidance for this full year. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and while I really am getting tired of talking about inflation and talking about the Fed here on the show, I'm sure you don't find it too exciting. I am going to try to move on from it quickly today. We're going to move on to more details about the markets. I am going to talk about some specific stocks, but I do have to start with a bit of what is still undoubtedly the most important aspect of what's moving the markets one way or another. And this was unfortunately reinforced to me this week. I spent a few days at a conference out of town. I got in front of and I listened to many hedge fund managers and private equity fund managers talking about their funds, of course, but also their macro outlook and their outlook for the markets. And it was much of the same, with a very heavy focus on the Fed and monetary policy. The good news is that the overwhelming sentiment from what I experienced, it's still largely defaulting. Their sentiments are, in most cases, defaulting to a slowing economy. In many cases, a likely recession, with all too often, definitely what I'm seeing is them selectively choosing data to reinforce this thesis, or at least not providing a reason whatsoever, saying, I think this, but not saying why. And they choose to ignore, in many cases, a lot of data that would conflict with this thesis. Now, the thesis may very well be right. I just don't think that they're taking a very well-rounded approach. They are collectively a bit myopic, and they don't like to stray from the herd very much. And this is a positive for you as an investor, because this is a lot of money. This is the real deal, big institutional money, and there is still a lot of it that's still positioned this way, despite the markets making new all-time highs this past week. And that's money that can or maybe will eventually come into the markets if they don't ultimately get their way. They might ultimately then capitulate. So there is basically a lot of money still on the sidelines, big money. And one interesting slide from one of the presenters' slide decks showed that by their estimates, the Fed's overnight rate has been lower than the neutral rate, so accommodative, helping the economy. It's basically been lower than that neutral rate since 1990, only approaching the neutral rate a couple of times really over those past 30 years, until, of course, recently moving into restrictive territory as they engage and combat inflation. So you can really see how easily we've had it for decades now, and how much that has correlated with a very long-term bull market. I mean, obviously there were some interruptions along the way, major corrections and recessions, but 30 years were a pretty strong 30 years because the Fed was juicing the economy. But in the end, again, at these presentations all focused on what the Fed's doing now, and we're really responding to, remarkably, citing and kept bringing up Jerome Powell's appearance on 60 Minutes. That was part of these big presentations over and over again, which followed the Fed's meeting and the decision that they had to not touch rates until at least May. And what Powell said on that show was, indeed, inflation has moved down sharply over the last 6 months. But while he said that they were almost unanimous that they're headed to interest rate cuts this year, they are not in a rush because, quote, when we see an economy strong like that, we feel we can approach the question as to when to cut interest rates carefully and, quote, more continuing to quote, we want to see that inflation is moving down to 2%. We have some confidence in that, and our confidence is rising, end quote. So they're ready to get the ball rolling, but they have this luxury of waiting until they're very sure, because they're seeing almost no signs of what would be the cost of waiting too long. And he actually was asked about that and addressed it in the interview. They don't have the threat of waiting too long to cut interest rates, and the cost of that would be a sharp slowdown in the economy and ultimately a spike in unemployment. And they're not seeing that anywhere in the data right now. But they are today well above their neutral rate, so they can start soon to begin to walk slowly towards that neutral stance. As he clarified, quote, "We won't wait for rates to get to 2% before cutting interest rates," end quote. And that goal of 2%, as they stated, isn't for 2024. That's the goal that they want to get to by next year. And even though it's pretty close, it's not supposed to happen until then. So they have the ability to cut rates, and they probably will, it's looking like, start it off in the May season. Will they start it off with 50 basis points or 25? And how much more comes after that? Well, that'll be continuing to be debated, unfortunately, also on this show. But it is now earnings season, so let's put aside the monetary policy for a bit. It's at the heart of everything the market's doing, but it's as dull as an old butter knife. And now we have real results to contend with. The markets came into this year at about 19 times the consensus FactSet estimate for the year's forward earnings. And while so many pundits were still calling for a recession, that 19 times bottom line growth of earnings is a growth rate in the low double digits. Today, the S&P is doing pretty well again. It's up about 5% for the year after seeing what was a more broad-based rally for a lot of the fourth quarter last year. But again, we're seeing leadership narrowing again as the equal-weighted version of the S&P 500 is still today flat for the year. We started off collectively, I don't mean we here at the team, and we, the Wall Street collective, I guess, had modest expectations. And I'll cite a Wall Street Journal article from January 7th here, which aimed to preview earnings season and said, quote, in the article, U.S. stocks defied expectations to rally in 2023, but have struggled to extend gains into the new year, end quote. This despite what I just said about the index. And the article goes on, quote, tech stocks, which led the market last year, have stumbled, end quote. Well, that's largely not the case now, a month after that article was released. And I guess largely because the results that have been delivered so far since the expectations for broad markets, again, back to that boring old monetary policy and interest rate talk, have really, the sentiment has soured over the past months. We've been disappointed with those that thought we'd get rate cuts sooner than later. But the markets have defied that. The NASDAQ, as a reflection, an easy reflection of the tech stock part of that, is up 6% for the year. So here we are a month later. Tech stocks have not stumbled as of yet. There's been some volatility, but where we are now, 5-6 weeks into the year, they're actually, again, narrowly leading the market. So where we are so far, well, the market started the year with expectations that companies would deliver growth for the fourth quarter last year of 1.3% from the same period the previous year. And the market was trading at 19 times 2024 estimates, not because 1.3% growth in the fourth quarter was so great, but because they had really good expectations for 2024 as a whole and for 2025. In fact, when I talk about a specific company, I'm going to specifically talk about estimates for the next year already. But those estimates are generally pretty optimistic, despite this, again, overarching macro consensus being pretty pessimistic, which is weird to kind of see how those two work side by side coming from the same office buildings. But now analysts do have this habit of setting low bars and then lowering them even further. And this 1-ish% estimate for the fourth quarter for earnings growth was actually an estimate of 8% earnings growth for the fourth quarter when the consensus got together in September. So that estimate came crashing down. But you also may remember that September and October were pretty bad months for the markets. We had this kind of mini correction, and then we saw them absolutely take off in November and December. So to put this together, we had high expectations in September, 8% growth for the quarter, with the markets trading off, and then a big run higher as these estimates were coming crashing down to almost zero growth. Where we sit today overall, according to FactSet, the S&P is now trading at 20 times this year's expected earnings based on a consensus forecast that earnings overall are going to grow 11% for this calendar year. And we've had over 50% of the companies in the S&P now report their fourth quarter results. And after lowering that bar, the actual results have been that 72% of the companies reporting have reported positive upside surprises to the estimates. And in many cases, though, that has resulted then, this whole podcast is about contradictions, I guess, because even though 72% of the companies have reported positive upside surprises, in many cases, it's resulted in the stock then selling off after the report, which in some cases is an episode of profit taking because we've had a few good months here. But really what this boils down to, again, is forward guidance. And if these companies can make the case that the 12 months ahead of us are going to deliver better results than they already reflect in these models, and that's already reflected in today's price, well, then they'll do well. And if they don't, then they're in trouble. Typically, just reiterating what's already cooked into the price isn't going to be enough to have the shares rally. Certainly not to rally if the shares are already trading at multiples that are already hard to justify. But in other cases, when the companies deliver guidance that is well above estimates, then they get re-rated higher, as you might expect. There was a prominent chip maker this week. They took up their full-year guidance by about 50%. They changed everyone's model to higher expected outcomes for this year, not next year, and so forth. And, of course, they saw a subsequent similar-type move in the price of that stock, as you might expect. That being said, now I'm going to run off here to a quick break, but I'm going to return in a moment with two examples from our portfolio that basically demonstrate the case of recent trading in the pessimistic kind of dump end of the market with low valuations, only to see their fortunes turn around in a relatively short period of time and the value being unleashed. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Inflation is running hotter, and returns are cooling down. Is your financial plan primed for a changing environment? I'm Simon Hamilton with the Wise Investor Show. Every week, we discuss the latest financial trends and what investors need to know about them. To learn more about the impact of higher prices and how to become a better informed, wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. As I said, I was traveling this week, and when I travel in the winter, I get sick. It's inevitable, so bear with my voice today. I apologize for that. But I'm going to finish today's podcast with two names who are largely, very largely in some cases, out of favor not too long ago, but have come back a long way, maybe after shedding some of the fleas in the headlines and delivering on more tangible results. They're both companies we own for our clients and which I own personally, so my view on them has an inherent conflict and a positive bias towards them, although I don't always love what I own at times, but yeah, there is a conflict there for the stocks. The first one's Disney, who came out swinging this past week with their most recent quarterly results, their yearly guidance, and they also announced about 3 major deals for the company as Bob Iger's return to leading the company has now really started to reshape and refine the expectations as well as this kind of struggling model that he found when he came back after leaving it for a few years, and he came back, not too long ago. The larger story may be obvious. Disney embarked on a major retooling years ago. They spent billions and billions of dollars on developing a big focus on the streaming platform or platforms, following a string of deals that were tens of billions more on additional content, including ultimately the purchase of all the Fox studio assets. Now, these moves largely floundered after Iger left, and they got whacked by the pandemic. It killed revenues at their theme parks, at the movie theaters, and subscriber growth has been strong. It hadn't been strong enough to justify the higher costs and the negative margins that continue to largely plague that part. So that battered Disney stock pretty good over the last year, actually mostly in 2022. Largely 2023 ended up being ultimately a positive year for the stock after it bottomed out at a pretty dismal low. But this past week, Disney released their quarterly results on Wednesday with revenues basically in line with expectations, earnings per share nicely actually above the consensus estimate, but they also delivered full-year guidance for earnings and free cash flow ahead of the current estimates, and they raised their dividend by 50%, which I think delivers a nice show of confidence from Iger, confidence in where their revenues and cash flow is coming from, as well as their balance sheet. More notable, though, the day before, they painted a clearer picture of the future for sports, or viewing sports, as they announced a big tie-up with two other major broadcasters in this joint venture, equally uniting Disney's ESPN streaming services with Warner Brothers, TNT, they have basketball and such on there, and Fox Sports. And then along came the earnings released. They announced that they'd also invest $1.5 billion in Epic Games. And Epic is the creator of Fortnite, which is incredibly popular. I don't know how the oldest player on there may be now, but let's say, tweens and teens are really dominant. I think it's one of the larger gaming platforms out there. And they've invested in this joint project, which is going to see them as a major stakeholder in Epic Games. And then Epic will be rolling out new online gaming for these young folks using Disney's characters, the Star Wars characters, the Marvel's characters, and so on. Then Iger finishes up his big week by announcing that Taylor Swift's new concert tour would be exclusively available to watch on Disney's streaming service, which, from what I've seen, she tends to get viewed over and over again by her fans. So another way of kind of locking up some sticky subscribers there on Disney+. Now, Disney shares traded 8% higher after these results, and they're now 20% higher for this calendar year, 38% higher than the lows from last year. Some tidbits from Wall Street on the stock. The analyst from KeyBank remained neutral on the name, but said that they're encouraged by the improvements in margins and the outlook for their DTC, their direct-to-consumer streaming effort, as well as strong results for the cruises. I forgot to mention, they also said that they're building a few new cruise ships and putting a bunch of new capital into improving the theme parks, which is one of the major issues that an activist shareholder has been after them to do. And they said that this will be the year that the streaming services become profitable. That is really the primary focus that came out of all the Wall Street reactions there. And that was the focus of an analyst over at Bernstein who said that, quote, while dividends, buybacks, free cash flow, and earnings per share can be discussed, the key metric is DTC profitability, with losses narrowing quarter over quarter, end quote. And they retained their outperform rating on the stock. And lastly, an analyst at Needham upgraded her rating on the stock to a buy from a hold, again, citing earnings, the streaming move to profitability, and also this new joint venture with Epic Games. She thinks these new streaming bundling plans may lower the churn on subscribers by 50%. And according to FactSet, the street now, and this may be a bit higher at the time I'm recording this because this FactSet data came out very close to the earnings release, so it might not have been fully published yet. But the street consensus is now that Disney should earn $5.37 a share in fiscal year 2025. Remember, I said I'm going to talk about the year out. Their fiscal year 2025 actually begins in the fourth quarter this year, which is when Disney says that streaming service is going to flip to profitability. So it's a key inflection point. That puts the shares at about 20 times that number right now, which I wouldn't, trumpet as particularly cheap. But the 5-year average for the stock is 30 times earnings, so it's not an extreme valuation either. Moving on, and a bit less dramatic, to another name that we own and I own. Just a real quick update here on AT&T, which is thankfully back to being as dull as watching paint dry. And I mean that in every positive way. That's what I want from AT&T. Last summer in July, it became less dull because Wall Street Journal ran a series of articles that really beat up AT&T on the front page on the issue of potential risks and cost exposure to how much lead AT&T had in their old phone lines across the country. And at the time, someone made the case. They basically said AT&T only has 2,000 miles of this, as they were trying to defend the stock. And I had no idea what to do with that number. Really, I thought the same person could have said, oh my God, AT&T has 2,000 miles of this stuff. I don't know if 2,000 miles of phone line is a lot or a little, but ultimately that person was making the case that the projected high side cost exposure of dealing with this, supposedly working in really worst case scenarios of liability exposure and cleanup exposure, that it all would result in less than 1 year's of earnings. And, completely throwing away 1 year's of earnings is not ideal. But for a stock that's really done nothing for many years other than to kind of chug out a very large dividend, this headline story moved the stock down to a low in July of $13.43 a share. And at that price, the dividend payout resulted in over an 8% yield. Well, the story is still out there. In fact, there was a headline just in January that AT&T is meeting with people from the EPA about addressing this issue. But I guess basically the street has gotten their minds around the enormity or the lack thereof of this issue, that the costs aren't really as extreme as maybe had been worried about. And these shares are now trading back at about almost $17 a share, which is still, I think, basically a boring yield story, a yield now over 6% a year. And most importantly, demonstrating the ability to continue to pay and maybe raise that dividend. In fact, they got a nice boost at the end of the year as they guided their full-year free cash flow to almost $17 billion and released some really strong subscriber growth numbers for their most important wireless business. Early this month, just in February, JP Morgan upgraded AT&T to overweight with a $21 target on the stock, saying, quote, the company has been able to show consistent execution in its wireless and broadband businesses, and we see a solid long-term growth for both segments, end quote. So, again, this isn't one I get too excited about, but it's one I rarely think about much overnight. The dividend is great, and these analysts keep saying that there's no reason to expect it to be threatened in any way, and that alone is pretty attractive. And in an environment which may see maybe eventually prevailing interest rates headed lower, it makes that dividend that much more attractive, and it should be reflected in the share price as well. Really, it's just an example of I'll say an odd disruption here in the form of a news story and therefore a resulting overreaction that created a real opportunity in some oversold shares. All right, that's it for me this week. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.